Hello fellow intelligent investors, my name is René Zellman and today I want to discuss Facebook stock, and more specifically I want to discuss whether Facebook will ever start paying a dividend, and if they do, when the company might make their debut in the dividend investing universe. So what I will do is I will discuss the capital allocation toolkit available to Facebook CEO Mark Zuckerberg. I will outline how he has used this toolkit in the past and what options Facebook has in the future. So without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, so for many years, Facebook has been one of the pioneers in the social media and digital advertising space. And Zuckerberg's company, although it is often hated, has brought users across the globe together. And clearly the success the tech company enjoyed has made Facebook an absolutely massive business. As of April 2021, Facebook has a market cap of roughly $850 billion, which makes it the sixth largest or most valuable company in the world, at least measured by market cap. And consequently, Facebook's stock would have been a life-changing investment if you invested early on, say you invested during its IPO, and then had the conviction to never sell your shares. $10,000 invested in Facebook on the day of the IPO in 2012 would be worth roughly $72,000 today, which represents an annualized return of almost 25%. Now, when companies become really big, they will at some point reach a point at which they are generating such large amounts of cash flows that they will eventually have to directly return capital to shareholders. And many companies do this through dividends. And maybe just for starters, Zuckerberg hasn't made the move to pay a dividend yet. But some people think that the firm should actually do it fairly soon in order to reward its shareholders. Now, I just said reward because in my view dividends are not necessarily like a holy grail in the world of investing. And later in this video I will actually outline why, generally speaking, I actually prefer companies that do not pay a dividend. But just to be clear here, conversations about when or if Facebook will issue a dividend are nothing new. In fact, when I conducted some research for this video, I came across articles dated back all the way to 2016 that they discussed this exact question. And certainly Facebook could be one of the largest dividend payers in the corporate world if they wanted to commit their free cash flow to a special, or maybe I should say a regular annual dividend. And there are already quite a lot of well-known technology companies that do pay a dividend, such as Apple, Microsoft comes to mind, Intel, Oracle, or Cisco. So the question is, should Facebook do the same? Now, I also want to reach beginner investors with my videos. So let's just very briefly define what a dividend payment actually is. Well, put in a nutshell, if a company generates profits, they have various options what to do with that profit, and management has to decide what they are going to do with their cash flows. And paying a dividend is one of these options. Essentially, dividends are payments a company makes to share profits directly with shareholders. Now, as you know, I'm a big proponent of the business owner mindset. So if you pretend to own an entire company, well, if you do decide to take out a portion of the profit, the cash flows the company generates, to go on vacation, for example, or maybe to donate money to charity or to purchase a property, well, then basically you are paying yourself a dividend. If we now consider Facebook specifically, well, if we take a look at the performance of Facebook over the last year, then we can see that the firm generated $38 billion in operating cash flow in its 2020 fiscal year, and roughly $23 billion of free cash flow. Moreover, Facebook is currently sitting on an astounding $61 billion of cash and marketable securities. And obviously the main job of management, so Mark Zuckerberg and his team, is to make decisions with regard to what to do with that money. Should they pay a dividend or maybe do something else with the cash? Using a company's financial resources effectively and in ways that will increase a firm's efficiency, that enhance a firm's long-term financial stability, and that create shareholder value is what is commonly referred to as capital allocation. So a CEO and his or her management team have to carefully think through what makes the most sense for generating future returns for the business and for shareholders, of course. And in fact, the CEO of a company has plenty of options of what he or she can do with the company's capital. And paying a dividend, as I said, is only one of the options. So let's briefly take a look at the other tools in Capital Allocator's Toolkit and consider to what extent Facebook made use of these tools in the past and whether it makes sense to deploy capital in these areas in the future. And once we have done that, we can then compare a dividend payment to these alternative options and decide whether Facebook should distribute capital directly to shareholders via a dividend. Essentially, a CEO has different tools in his toolkit to raise capital, but we're going to ignore these tools in this video. And then there are exactly 6 areas where a CEO can deploy a company's earnings. He or she can just do nothing with the earnings and let it sit on the balance sheet. The CEO can use profits and cash reserves to buy other companies. He or she can use the capital generated by a company to pay down debt. He or she might also buy back the firm's own shares. Another option is to pay out a dividend to shareholders. And maybe a last one is to reinvest the money back in the business. And again, let me just show you a few beautiful graphs here that were created by Heikki Keskiäväli that show how companies can use this capital allocation toolkit very differently. So obviously, what these graphs here show is that there is no one-size-fits-all approach, no magic formula when it comes to capital allocation. And I think these graphs are incredibly beautiful, so give Heikki a follow on Twitter. So let's start with the option of doing nothing. Well, in a way, I would say Facebook has made use of this tool because over the years, Facebook has built up an impressive 61 billion war chest of cash and marketable securities. This number is up from 11.2 billion in 2014. And I think in a way this shows that even if Facebook would make another major acquisition, say of a similar size like its $19 billion purchase of WhatsApp in 2014, it would still leave Facebook with plenty of cash to play a special dividend or a regular dividend. And generally speaking, hoarding cash on your balance sheet or on a company's balance sheet should not be considered a good long-term capital allocation strategy. But just like cash provides option value to individual investors, so you and me, for example, it also provides option value to businesses. And in fact, I believe that investors should love business leaders or CEOs that do acquisitions somewhat rarely. And the term used in the investing world here would be they use or make acquisitions opportunistically. So in a way, we are already speaking of a second capital allocation tool, and that's acquisitions. Well, Zuckerberg made some major acquisitions in the past. Let me give you a few examples here. He bought Instagram for $1 billion in 2012. And actually, I think it is rumored that the negotiations only took him 48 hours to reach an agreement. Now, what I also want to point out is that I've heard people speculating that Instagram on its own today would already be worth $300 billion. Then we've already mentioned that in 2014, Facebook acquired WhatsApp for $19 billion. And in the same year, actually, Facebook purchased another company, virtual reality platform Oculus, for $2 billion. All of these acquisitions, I would say, turned out to be massive home runs, even if their purchase price at the time might have seemed elevated. And in this context, one might also point out that in April of 2020, Facebook struck quite a massive deal with Indian technology company Reliance Jio Platforms. I think they made an investment of roughly $6 billion. Essentially, Facebook acquired 9.99% stake in the company. And in the context of Facebook's acquisition history, let me just maybe mention one more example. I think Facebook also attempted to acquire game engine company Unity. In fact, in the book, The History of the Future, there is like a 2,500 word email by Zuckerberg that is dated back to 2015. And in this email, Zuckerberg laid out an argument for further prioritizing AR and VR and buying the game engine company. And I think if you haven't read this email yet, feel free to pause the video here, because it very clearly shows what a visionary CEO Zuckerberg is, and that he indeed only acquires companies opportunistically. So, in the context of judging Facebook's capital allocation options and assessing whether the firm should pay a dividend, one should also take into account that every once in a while Zuckerberg apparently can strike a fascinating or value-creating acquisition deal. And even though I think it's quite unlikely that Facebook will be able to deploy all of the cash that they have on their balance sheet, future deals might still use up a significant portion of Facebook's cash reserves. All right, before we move on to the next capital allocation tool, I hope you can tell that it takes quite a lot of effort to make these videos. So if you like my content and want to support me on my journey, you could help me out massively if you could just very quickly hit the like button of this video, or even better, just leave a comment. Thanks. All right, another capital allocation tool is to pay down debt. Well, if we take a brief look at Facebook's balance sheet again and Facebook's debt profile, we can immediately tell that Facebook has no significant debt, considering Facebook's big cash reserve, the firm's ability to generate billions in cash flow each year, and the presumably low interest rates on the outstanding debt. I think there's no need to pay off the little debt the firm has right now. I think the capital available to management can be used more effectively elsewhere. So this leaves us with two more capital allocation options that we haven't discussed yet. Well, we already talked about a dividend, and this is only one form to directly return capital to shareholders. But there's another form. Another form to directly return capital to shareholders are share buybacks or share repurchases. A share buyback is a decision by a company to buy back its own shares from the public market. By reducing the share count, share buybacks essentially give each remaining shareholder a larger ownership position in of the entire company, a larger piece of the pie, so to say. And there's one crucial difference between a dividend and a buyback program that I think investors should be aware of. Unlike a dividend payment, a buyback is not a taxable event for shareholders when it happens. So investors do not have to pay taxes until they eventually sell their shares. At that point in time, they obviously have to pay capital gains taxes. One problem with dividends is a phenomenon called double taxation, because effectively dividends, so the money distributed to shareholders, the dividends are taxed twice. Once on the corporate level, income taxes the corporation has to pay, and once on the personal level, when shareholders pay income taxes on their personal dividend income. Also, unlike dividends, buybacks are a much more flexible use of a company's cash. And ideally, a company only buys back its own stock when management believes that the current share price does not reflect the true worth of that business. Because only if management, again, conducts buybacks opportunistically, they can truly create shareholder value. So what about Facebook, you might wonder? Well, the social media giant first created a share repurchase program back in 2016. And in 2020, just to give you some numbers here, Facebook repurchased $6.3 billion worth of its own stock, leaving $8.6 billion of the share repurchase program remaining. But in January of this year, so 2021, an additional $25 billion of repurchases was authorized by the board. So I think it seems like share repurchases, buybacks, have become a regular practice at Facebook. But if you consider the following graph, investors can hope that share buybacks are executed in, as I said, an opportunistic manner, which would create more shareholder value. Nonetheless, proponents of Facebook paying a dividend might argue that the current pace of share repurchases still leaves a significant amount of cash flow available for dividends. But we haven't spoken about the last capital allocation tool yet, and that is to reinvest profits back into the business, to invest in internal business growth. So again, just to be clear, the main argument for Facebook starting to pay a dividend would be that the social media company could be nearing the peak of its growth story. Over the course of the last decade, Facebook has been one of the most successful companies in the world. I think I pointed that out in the beginning of the video. But can they really continue to grow at that pace? That's the question. We've already also addressed the enormous size Facebook has already reached. Let me maybe just show you the revenue growth rates over the past 9 to 10 years. Massive user growth and the aforementioned home run acquisitions have contributed to the insane annualized growth rates for investors. Even at its current size, the company continues to post double-digit revenue growth rates. And personally, I think Facebook can continue to grow at a fast clip and can reinvest billions of dollars of cash flow it generates each year. And what I want to do here is I want to briefly outline a couple of key areas in which I think Facebook is already quite heavily reinvesting its cash flows right now. And I've identified 3 areas. So firstly, I think Facebook can continue to reinvest in its core business, the firm's core competence. So that would include digital infrastructure, data centers, servers, etc. Because this infrastructure is a prerequisite to store all of the information that is being uploaded and viewed on Facebook's social media platforms. In fact, Facebook's business operations require a relatively high level of reinvestment into its core business, with capex climbing up to 30 to 40% of operating cash flow over the past couple of years or over the course of the past decade. How much of this is maintenance capex, so expenditures to maintain the business operations as they are today, and how much of this is actually growth capex, it's hard to say from the outside. But generally speaking, one can make the assessment that the digital marketing sector is still expanding, along with the increasing penetration of internet services and mobile devices. Facebook's ARPU, so that's average revenue per user, in the EU region and the US, compared to the ARPU in the Asia-Pacific region, supports this thesis. And I think there's still plenty of room for growth for Facebook here. Here's what Facebook's CFO, David Weiner, said in 2020. Our significant investments in the infrastructure over the past 4 years have served us well during this period of high user engagement. We plan to continue to grow our CapEx investments to enhance and expand our global infrastructure footprint over the long term. In 2020, we expect capital expenditures to be approximately 14 to 16 billion. I would like to stress that the data Facebook generates is actually an immense intangible asset, even though Facebook has been under constant scrutiny by privacy groups and federal agencies. A second growth opportunity can be found in the e-commerce sector. In May 2020, Facebook actually launched Facebook Shops to help small businesses and empower them to connect with their customers online. Essentially, Facebook Shops is a mobile-first shopping experience, and businesses can easily create their online storefront on one of Facebook's apps, such as Facebook or Instagram. And here Facebook will be competing with companies such as Etsy or Amazon, of course. And Facebook's COO, who is Sheryl Sandberg, she said during Facebook's most recent Q4 conference call that it's still really early days. And obviously, Facebook plans to expand its reach into the growing e-commerce market, as it would help to diversify Facebook's revenue that is relying quite heavily on the advertising business. Setting up a Facebook store on Facebook Shops is free, and small businesses, regardless of their size and their budget, can choose the products that they want to offer, and then they can customize the look and the feel of their shop with, for example, a cover image or the colors that should showcase their brand. And according to Deutsche Bank analysts, there are already 1 million active shops on Facebook's social media platforms, and 250 million people interact with those shops on a monthly basis. And I think there is a third way that might help Facebook diversify its revenue streams, and that's the realm of augmented and virtual reality, so AR and VR. We've already mentioned Facebook's 2014 acquisition of Oculus VR, which is a virtual reality technology company. And especially in the context of the recent conflict between Apple and Facebook over privacy issues, Zuckerberg has been more and more vocal about his ambitions to make Facebook a leader when it comes to the next major computing platform. in order to be less dependent on Apple. Quite recently, a report came out and highlighted that almost a fifth, yes, you heard that right, a fifth of Facebook's employees are now working on VR or AR. And thus the firm is significantly accelerating its VR and AR efforts. To give us some more context here, Facebook now has 10,000 people working on AR and VR devices. And obviously employing all of these people costs money, and this is clearly a growth investment. Let me just show you what CEO Mark Zuckerberg said during an interview with the magazine The Information. Today, most of what Facebook does is we're building on top of other people's platforms. I think it really makes sense for us to invest deeply to help shape what I think is going to be the next major computing platform. This combination of augmented and virtual reality, to make sure that it develops in this way that is fundamentally about being present with each other and coming together. So what's the bottom line here? Personally, I don't think that Facebook is going to start paying a dividend anytime soon. Apparently, Facebook is investing billions of dollars in AR and VR technologies in order to make it a gatekeeper if augmented reality becomes the next major computing platform. And moreover, Facebook is still investing quite heavily in its own data infrastructure and also in the e-commerce space, which might also provide another attractive opportunity for Facebook in the future. And in addition to that, Facebook has started buying back its own stock, which in a way indicates that there might be a preference for share repurchases over dividends. So I don't think Facebook will pay a dividend anytime soon. Surely Facebook could afford to pay a dividend, considering its free cash flow of 23 billion a year and a market cap of 850 billion. A 1% dividend yield would consume about a third of the free cash flow generated by the company. And we've also addressed the cash pile that Facebook is sitting on right now. One could also make the case that Facebook could certainly go for a lower dividend yield and then still reinvest the vast majority of its cash flow into its own business. And this is what Apple is doing, for example. The company started paying a dividend in 2012 when Apple reached a certain level of maturity. But as I said, Apple could still and is still reinvesting a large portion of its cash flow back into its own business. And the stock continues to do fabulously. Nonetheless, I think a dividend paying Facebook is quite unlikely. Zuckerberg is incredibly focused on his vision, his mission, and so far, with him at the helmet of the company, Facebook has created tremendous shareholder value. I would say Zuckerberg is a textbook example of what Ensemble Capital call a visionary founder. In the aforementioned podcast interview with The Information, Zuckerberg spoke about his dream of allowing users to create their own avatars in an augmented reality world. What he was saying during this podcast sounded like outright science fiction, I would say.
When I think about where you're at with VR today, you go into the experience. There's some pretty good games and different experiences. But I'd love to get to the point where you have realistic avatars of yourself, and where you can make real, authentic eye contact with someone and have real expressions that get reflected on your avatar. So what do you need for that? Well, you need basically you need to be able to do eye tracking to do eye contact. You need to have some sense of face tracking or sense of what's going on with the person's expressions in order to be able to have those emotions kind of come through naturally. Building the avatars is something that we invest a lot in, right? I mean, 3D renderings of people is it's a very complex space. Epic, the company that makes Unreal, the engine just released a what seems like a pretty awesome tool for basically creating realistic human-like avatars. It previously would have taken a very talented artist, maybe weeks to do that, and now with their new tool, maybe it'll take them on the order of a day. But that's not enough to scale for the use cases that we're trying to create, right? You're not going to be able to have a world-class talented artist manually spend a day to create a realistic avatar for tens of millions of people. So we need to develop the technology and the machine learning to be able to have those kind of avatars. And that's going to be a thing that we're constantly upgrading. And that it'll be a journey to get to there. But I think the next version of the avatar system will launch on our headsets this year, and it'll just get more and more realistic over time. But that's a big challenge too.
If you are investing in Facebook, I think part of your investment thesis has to be management's capital allocation abilities. And as I've pointed out in my video on founder-led companies, I don't think anybody can run a firm better than a founder CEO. And Zuckerberg, so short Zuck, clearly has this extra ambition to make Facebook to continue to be a success story. After all, it's his baby. So if you are a Facebook shareholder, I think you just have to trust Zuckerberg and his management team to make the right capital allocation decisions, and should not be overly focused on whether Facebook pays a dividend or not. In fact, in its 2020 10K, Facebook also stated that they have never declared or paid cash dividends on our capital stock. We currently intend to retain any future earnings to finance the operation and expansion of our business and fund our share repurchase program. And we do not expect to declare or pay any cash dividends in the foreseeable future. As a result, you may only receive a return on your investment in our Class A common stock if the trading price of your shares increases. Alright, and it has been quite a long video already, so that should already be it for today. As always, may your finances and investments prosper. Good luck!